Hello, hello. How's everyone doing today? Hope you guys are having a wonderful Wednesday. We're going to be going in this video over what the Federal Reserve is pretty much said. And we're going to go over the numbers first here. This is where the real information is. And then we're going to go over his speech. And it's a little bit behind. I do this on purpose so you guys can see the fluctuations of the market in real time from your own perspective, and then we'll go ahead and then rehash over it. So this will be a tremendous learning experience as you guys learn how the markets work. There's people out there that essentially read these specific projections here, realized it was a bad not as good as what we expected. They go ahead, short the market really quickly. Once it hits the key levels of support and resistance, then they went ahead and brought it back up. So it's a beautiful way of making essentially what normally people make in real estate in a year, pretty much make every couple of months, right? So let me know if you guys hear me, and we're just going to go ahead and get started. And please comment down in the chat if you guys hear me. So for our Mastering Stock Market students, as well as our stock alerts here, this is an important determinant right now because a lot of people stepped in the stock market in 2020 and then also in 2021. And the thing is, they don't really understand how the market works. They don't understand that the whole free money that you make, you buying a stock and then going up the next day, that doesn't really happen in the stock market. It takes time. It's like planting a seed in a farm. You don't just keep checking it every minute, expecting it to just somehow pop a bean sprout to the heavens. That doesn't work, right? Businesses take time. So I do have some concerns with this report, and I'm just going to kind of show you how I go over these reports. So, beautiful. Thank you so much, Frank. I appreciate that. Thank you. And I'm happy to be here, and I'm happy to support you guys. So, as you can see here, these are the economic projections of the Federal Reserve Board meeting that is literally happening today. Okay? Well, yeah, the market is reversing, but it was a good short-term hedge. But yeah, absolutely, it's you're not the only person. You know, this is how experienced people do in the market. Exactly. So, one thing that I just want to point out. Let's go down here. This is where everyone's looking at. This is the first thing people look at, right? If you look at 2022. You got 1.9, then 2.8, then stabilization. However, you have to understand something, guys. Okay, I'm going to go ahead and bring back the projections from last December, and this is in our private Discord channel. If you look at Federal Reserve predictions or predictions, you will see this specific picture. And this was from the December 2021 meeting. You can see that the federal funds rate in 2022 was 0.9. Again, it said that right here. That's where this 0.9 comes from. Now they just increased it by a solid 1.0. Now, we're expecting a 0.25 basis point hike. However, if you do the math, we only have like 6 more meetings left. So if you do the math, 1.9 divided by 0.25 is going to be 7.6. So that's highly unlikely that we're going to be able to squeeze that many rate hikes within a year, which signifies that we are definitely going to be getting a 6 rate hike within this year. However, we may be getting a 0.5 basis point hike within some time of this year. We don't know when. But what that basically signifies and what that tells us is that the Federal Reserve is going to be hawkish. Just looking at that number, that's how much information I just got. Okay, that's essentially the power of utilizing this information. So already I know, and I can quickly just go on the market as soon as this popped out, and I can make money. Okay, so just like that. Okay, so now let's go ahead and focus on GDP, gross domestic product. Now this is essentially how you essentially analyze a country's production. People think that Russia is strong. No, honestly, they're not. No offense, Russia, but you're not, right? The reason why is because their GDP is that I think France has a stronger GDP than Russia. It's a dying country, and it's just a pipelined oil gas country. That's pretty much what, no offense to the Russian people, but that's pretty much all it is, right? So, however, though, we do see a problem. In the December projections, the GDP was 4.0. Now the GDP is 2.8. That's not good. Now, that could be short-term volatility of the Ukraine and Russia war. we don't know. But I tell you right now, this GDP decrease, it signifies that there is going to be a slowdown, which coincides with the M2 money supply that I showed you guys way back a couple live streams ago for Clover Health. That is, stabilizing low as well, which signifies not a lot of people are going to be spending money, right? So this is not good. This might lead to stagflation, which it's very different. We haven't really. This is a theoretical thing that we haven't really seen in the markets. Maybe possibly the Volcker era, but it's very difficult to live through those. Those are not good times for the markets. But as you can see, the GDP here is abysmal. And if you were to look at the past projections here, we're expecting 4.0 and then transitioning down. Well, now we're transitioning down immediately here, so that's not good. The unemployment rate, again, was on track. However, it is somehow ticking up in 2024. Now, who knows? We might be going into a recession, maybe into the end of 2022, or maybe during 2022, and maybe 2024 will possibly get out of a recession. But what this basically tells me, from a core PCE standpoint, 2.3, and I skipped over this here, but just it tells me that stocks are going to do extremely well in 2025. Which is why my price targets are scheduled out for that range. Hopefully by then the Russia-Ukraine thing clears up and China doesn't invade into Taiwan and North Korea doesn't fire more missiles or tries to go into South Korea in terms of their Navy area, and then Iran with their whole nuclear development program, and then Saudi Arabia with their trying to basically accept the Chinese currency over the US. There's a lot of issues going on, and hopefully those sort themselves out so we can go through a peaceful and prosperous time so everyone can make freaking money and we can live and enjoy the life that we have in Mother Earth. Okay? No, I appreciate that. No, God bless you guys. Thank you. I appreciate that. So now let's go ahead and let's look at PCE. Now, you might be asking me, what's the difference between PCE and core PCE? Now, core PCE excludes energy prices, okay? Energy, you already know, is controlled by geopolitical risks. So it's nice to look at the core, okay? Which is why the core sometimes, all the time, honestly, is always lower than the PCE, okay? So as you can see here, we're expecting some high inflation in 2022. We were actually thinking it was 2.6. Now, if you go back to the core PCE here, we're at 5.3 to 4.2 for 2021, and these were the projections here. The beautiful part is that we do expect them to go down extremely in 2023. Now, here's the thing. The reason why we're expecting them to go down that much is because look at the amount of rate hikes that we're going to end up doing. It's a lot. We for sure right now we're going to be doing 6 rate hikes. And I already updated you guys on that on our private Discord channel, which I don't have up here, but you guys can see it in our private Discord channel in our exclusive daily briefings today. I updated you and I told you how many rate hikes they're going to be. Okay. So there's that. Now, all together here, this gives you the range and whatnot, but we'll go over this in our Mastering Stock Market course in one of our projections. I will be updating a couple of our intrinsic value calculations on how to use Mastering Stock Market course on free cash flow positive and free net income positive companies, because now we're at a position where those stocks are actually undervalued. So that we got to get our hands dirty on those. So let's go down here really quickly, and these are essentially the graphs. So we're expecting a growing GDP, but now all of a sudden the Federal Reserve is saying, well, we're going to get a slowdown, and that's something that honestly is not good for the economy here. Then we were expecting an employment rate to go down, but for some reason it's trickling up in 2024, and then in the longer run, the unemployment rate is going to go higher. And again, where am I getting these numbers from? Here, look at the unemployment rate, 3.5, 3.5, and then 3.6. Longer run, 4.0. That's not good. I don't want a recession to bleed into 2025. Honestly, I would rather a recession happen now than that of later. But luckily, what that basically means is that if a recession does happen here, there, we already know, and if you guys haven't joined in our Ray Dalio premiere, which I basically live streamed with you yesterday, there's a couple of concepts that you need to understand to help you outperform and beat, essentially, sadly, 90% of people in the market, probably even more, because education, when it comes to this, is extremely important. You see, there's different types and levels of education, okay? You have pre-medical school and medical school education, which is good information, but you really can't use that information until you learn it over 4, 5, 6 years, right? It's very, because there's so many bureaucratic lines you have to cross, as it should be, because you're dealing with human life. But when it comes to stock market information and the information I'm presenting you, each and every one of you can change your life just like this. That's how amazing this market is. If you understand, that's why knowledge is power. If you understand information faster than someone else by knowing where to look, by having market experience, you're able to make so much money because you're thinking like a billionaire, okay? So what this basically tells you is that if, for example, we do head into a recession, what is the Federal Reserve going to do? They're going to whip out the money printer. And as soon as they whip out the money printer, same thing happened in 2020. Everyone's going to put their money in stocks. And then guess what's going to happen to the tech sector? So actually, when it comes to analyzing this and taking a look at what companies I like to invest in, this tells me I made the right move. When everyone was flowing into tech stocks, I was going into energy and banking stocks, the boring stocks. Now everyone's flowing into the banking and energy stocks. I'm flowing out and I'm going into the tech stocks because I know that in 2023 and 2024, we're going to be bullish, right? Because people are going to want to look at growth companies. They want growth. They're hungry for growth because everything else is going to be stagnant. And you need artificial intelligent technology with Clover Assistant, Palantir, in order to basically shrink that work gap in order to have productivity. Because obviously the country's productivity is not going to be good. So I hope that basically summarizes to you what's going on in my mind. Okay. So I think this is a good breakdown of what happened. These are the dot plots here. And we pretty much essentially went over this in verbalization, and then we'll be going over this in our course here. But the main point, the takeaway here, is this particular region, which was released 2 p.m. at the Eastern Standard Time. All right, so now let's go ahead and we're going to switch gears and we're going to talk to you guys about the Federal Reserve FOMC meeting, and we're going to hear from him essentially what we talked about. We'll listen to maybe 3-4 questions. However, we are going to put the transcripts in our Mastering Stock, in our Al Stock Alerts Discord channel, and so people can go in and take a look at the Q&As and internalize them themselves. The questions that most likely I speculate people are having based off I've listened to these so many years here, guys. People are going to be like, how many rate hikes are we going to have? When is we're going to have a 50-point basis rate hike? In terms of just in terms of core inflation, do you really think it's going to happen in next year? So these are the types of questions you're going to be hearing. So we're going to go in and tune in on here. I'm going to go ahead and change the Chrome tab to audio so you guys can hear what this guy says here. So give me a moment here. Please let me know if you have any questions. And sorry if my voice is choppy. I'm not feeling well. All right. And here we go. I'm going to put it at 1.5 the speed, which is why I like to do this after. If it's too fast, let me know and I'll slow it down. Put it in the comment chat.
Good afternoon. I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic. The financial and economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for work. The committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year, and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer-lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside.
All right, guys. So I just wanted to just pause this really quickly and just talk to you guys about something that's important here. So what this is measuring is just inflation, even with the crude oil, not the core, right? And as you can see here, like we stated, again, what he's doing right now, what he's explaining is exactly what we explained here. They're getting their graphs from here. So we already went over this. You see how quickly we can go over it without even having him basically talk about it, right? So what I'm trying to say here is that by 2023, we should be getting a PCE inflation at 2.7. That's really good, right? That's really good because all the rate hikes they're going to be doing this year. So this year, 2022 is going to be very tough, okay? But check this out. Check this out. What's going to happen, do you think, when inflation goes down to in 2023? People are going to want to seek growth. They want growth stocks. And that is when you're going to start, even possibly, since we know it's going to happen in 2023, the market is forward looking. So possibly midway in 2022 or the end of 2023, or sorry, the end of 2022, we're going to start seeing a sector rotation. And the sector rotation is essentially going to go into tech stocks and then flow out of the energy and real estate too, possibly, right? And we're going to go into that graph right now. I'm going to show you, which is in our private Discord channel. So I just wanted to kind of point that out, because what's special going to happen in 2023? Clover Health is going to become profitable, right? I think it's going to take longer, but if they can pull it off, you can start to see how these stocks will start to see a lot of money inflow, right? So just think about all those, right? Formulate your investment thesis.
The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Let's go to Gina at the New York Times.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
So I guess I would start by saying that in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market,
Exactly, guys. So if you look at the labor market right now, everyone's basically scrambling to get workers in. You know what I mean? You also have coming out of the pandemic, everyone just wants to travel. So America is going to be racking up a lot of debt. However, the V2 money supply says otherwise. But it's a solid question, and I believe we are headed into a recession. I don't think it's going to be 2022. It might be 2023 or 2024, hence why the unemployment rate somehow creeped up back in 2024 from the data I just showed you. This data right here. The little creep up here in the longer 4.0, that's a big increase. What's going to happen here? Right? So think about that.
also very strong. Conditions are tight and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Thank you. Let's go to Howard at Reuters.
Hi, Chair Powell. I was wondering, in the steps, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering how much of
Exactly. So you know how that floor GDP just changed? He's hitting on that data point that I'm like, holy moly, that's a big decrease in GDP. So you could start to see the thinking that I hope you are starting to see, that the alignment in thinking a lot of these macroeconomists, business people, millionaires and billionaires think that is a big data. However, this is where I just want to just add, because I am going to become a physician and I want to help the historically marginalized. Just a quick diversion away from stocks, just really quickly here. Do you think the poor people right now that are working 2 jobs trying to stay afloat, you think they have time to listen to this Federal Reserve meeting? Do you think the poor people have an opportunity to understand what GDP and all this is and how it relates? They're too busy trying to stay afloat. So just keep in mind, though, it is a privilege doing what we're doing right now. This is a privilege. This is what the top 1% do, right? Listen to this and try to make a move, right? So just put that into perspective, okay?
that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels. Highly uncertain, but you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1 3/4%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
So
Exactly. So this guy, that's why I always like to listen to the first 3 questions, and then I'm going to pass it on to you guys in our private Discord channel. We'll just drop this in there and you guys can watch it. But he asked the second question that I had. You remember how I did the calculation between 1.9 divided by 0.25? We got 7.25 rate hikes. Didn't make sense because there's only 6 more meetings, right? So it doesn't make any sense. That means they have to basically do a 0.5 rate hike. He's asking that. He's like, you're going to probably have one big one, aren't you? Right? And let's see what he says.
The way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with a combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that at the before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year, and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
All right, guys. So what we're going to do right now is I just wanted to kind of close this off and kind of give a just quick summary and just take the highlight points of what I took out of this meeting. Let me go ahead and share the screen here. All right, guys, so check this out. A couple things of interest here is that, you know, GDP, as what he was saying, is pretty strong, not the 4 to 5 we're expecting here, but it definitely is a decrease, okay? In the longer run is going back to the baseline of what we had. Now, I expect, you know, in order to be more productive now, you're going to have to essentially have a product line that allows you to do more with less, which is why companies like Palantir, companies that are able to essentially decrease, first off, the amount of work, but use that work and multiply it by 10. Those are the companies that you're going to want, right? The whole, I would say, hardcore physical companies it's going to be very difficult, and I'll get into those things. It's going to be very difficult to make a profit on those types of businesses. If you don't utilize technology, it's almost like a company not having access to internet. So it's not good. So with that stated, I believe 2023 is going to be a crucial year because the inflation is essentially going to be almost cut in half, which is extremely good. Inflation is not going to get hurt. Short-term bonds are going to be protective. However, with inflation, though, these interest rates are great for the short-term bonds, but with this inflation, though, bonds don't have a price purchasing. Whatever you buy is what you get. So stocks tend to outperform bonds, which is indicative of Chapter 2 of The Intelligent Investor by Benjamin Graham, who taught Warren Buffett, which is also will be incorporated within our Intelligent Investor course that is in beta access as well. But by looking at this component here, what we're starting to see, again, this is our private Discord channel here at Al Stock Alerts. This is a tremendous, important graph here. So we're just going to go into this really well. As you can see right now, everyone's flying into energy. But again, guys, by then, it was too late. If you really wanted to get into this, you should have gotten into this in November. I made a video about it, about energy around here, right? We started to see an upward slope. In fact, you know, and then we started to see a downward in technology inversion here. So, but now it's already gone up, and these prices are so cyclical that they can go up really hard and they can come down crashing hard. So now, while everyone is rushing into, because in the beginning here, everyone was rushing into tech, right? Now everyone's rushing into energy. And the beautiful part about this is when it comes to the stock market, you got to think opposite. You always have to be a contrarian. That's just how you make money in the market. You always have to think opposite of what people do, but you got to think about it and say, am I thinking correctly in this opposite way of thinking? Because if you don't, then the market sometimes might be right? So you got to look at those things. But majority of time, the market is usually wrong, right? But over in the long term, the market's right, if that makes sense. So right now, no one wants to touch PayPal, Facebook, Clover Health, Palantir. You know, no one wants to touch these stocks. But I'll tell you something, guys. Once this flips and once they're trading at an insane valuation, you're going to see people come on in, right? And they're going to chase those high growth stocks. But then by then, you've already purchased them at such a low discount that you're going to be selling it to them because you have access to our intrinsic value calculator, because you can calculate the value of each stock. So you know exactly what the value of it is. So then you can give it to them. They'll purchase it. You can go on and purchase the other sector that's been beaten down or just left. And then you can put a put option on the other one, wait till it comes crashing down. They freak out saying this is a SHIT stock. You know what I mean? It's a scam. And then you can go ahead, repurchase it back, and then continue to do it over and over and over again. This is the power of education. This is the power of understanding how this market works. But in order to do that, you need to have all of this data coming in, and you got to be able to clean it out into a beautiful signal, which is what we're doing here. Okay. So I hope that was helpful. Tomorrow we have a report for GameStop. That's important because it's going to send and tell us the direction of where these meme stocks are headed. You know, because if with this whole tightening of monetary policy, there is no more free money propping up the market anymore. This is the real stock market being run by the big boys, being run by corporate lobbyists, right? So you need to have access to information to track what the, you know, using the AI, and you can go ahead and go specifically to other companies and purchase them, but they're insanely expensive. So you don't need what we offer here. There's you can go directly, but I go directly to them and pay higher in order to get a enterprise license to help. But something that's important here, I would like to point out, is that it's important to track what the Senate and House are buying. It's important to look at their purchases and their sales and what they're looking at. For example, why are they buying? Why are they selling? It's important to look at that, and we can track how well they've done in the past, so you don't follow a dumb representative, right? So let's go ahead and answer some questions here. How do we know when the sector is up or down? So there are a couple ways. The best way is in our private Discord channel. Usually this costs money to get the sector analysis. It costs money. But for you guys, you just click on this and it pretty much highlights it for you. And it gives you, and I update this constantly here. And also, so it tells you here the sector of what's up. And if you want real-time data, our brain machine will be giving you guys, this is our own artificial intelligent technology. All you got to do is enter the commodity price AL, which is my name, / the sector rotation, and it will basically tells you where's money flowing. So I hope that that answers the question. All right, GME has been going down after the last 3 earnings. Not too bullish on the stock. Does GME affect all meme stocks? Well, it's because it's the first movement. People look at that because that's like the base. But I wouldn't call Clover Health a meme stock. Clover Health is a big. It's a company backed by smart people. Okay. Perfect. Okay. So, yeah. So that's about it in terms of the FOMC meeting. If you guys want to catch more of it, it'll be here. All you got to do, I'll put it down here for you. And we can update the transcripts. So if you guys don't want to read, you could just look at the transcripts here. But it's always nice to just hear it out. This is the tester channel, so I have to put it in later. But yeah, and also congratulations to our students here raking in some profits. So this is awesome. So it's really good. But other than that, we already have people looking at interest rates for banks, recession, looking at the probability of recession. So this is great. This is good. All right. So I think that's it. Any more questions, please drop them in. But we're pretty much done here. Thank you for joining. And I hope that was helpful. Peace.